Well, good afternoon, everybody. Welcome back to another episode of the Industrial Real Estate Show. I am pleased to be joined by a repeat guest, Joel Friedland. Thank you so much for joining me for a second episode.
Chad, it's great to see you again.
Likewise, we had a lot to talk about last time, and a lot has actually changed since the last time that we talked. So I think there's a number of different topics we can explore. State of the industrial real estate market right now, what's in store for 2025, what do you see even in the medium to long term? And I also want to just get your thoughts on some of the challenges that I think are in the real estate market, perhaps more broadly, but even industrial specifically. So with that, why don't you catch us up on what's been going on in your world with Brit Properties over the last couple of years and how the market's doing for you guys?
Sure. We are buying industrial buildings. Unfortunately, the prices for acquisitions are still as high as they've ever been. We have not seen any reduction in the Chicago market in pricing per square foot for purchasing properties. We have seen a slowdown in leasing. That's been a dramatic slowdown. Crickets is what I've heard from some of the brokers in town. In our case, we do have some smaller buildings, and in the small building size, there is a lot happening. I think it's because entrepreneurs are always out there, even when everybody else thinks they're not aware that things aren't good. So they just keep going. The small companies that do, let's say, $3 million and less in volume.
Well, that actually touches on one of the topics that I wanted to get your thoughts on, because it's interesting with industrial real estate is that it often just gets grouped into one conversation. So if you hear a statistic mentioned in the news, or if you see a market report, they'll say the industrial real estate vacancy rate, and maybe they'll reference Chicago, maybe it'll be a nationwide statistic or wherever it is, but it'll just say industrial real estate vacancy rate 5%, just using an arbitrary number. But that doesn't differentiate between the 300,000 square foot warehouse market and the 20,000 square foot manufacturing or flex type of industrial. And there's a huge difference, not just in the market conditions, but in lease rates, vacancy rates, sentiment within the market. I suspect that we're going to see some even more slowdown on that big bomber warehouse side, because there's been so much built speculatively as we went through this massive ramp up in 2022, 2023. And now you've got some tighter economic conditions. Market seems to be soft. But I also think in that range, which I know that you own a number of properties in that 20 to 30,000 square foot range, those do seem to be quite healthy. How do you explain why there's such a Actually, maybe a two-part question. Why do you think it is that everything just gets grouped into one category? And then what's your thoughts on the differences between the different subcategories of industrial?
Well, the reason I think it gets grouped together is because we as practitioners in the business know that there are really 5 different kinds of industrial. But the people who write articles and who work for the Wall Street Journal or the local business journals, they just hear the word industrial and they think, oh, industrial. The same way people hear office and they think, oh, office. But there's a very big difference in our market between suburban office and city office. And there's a huge difference between Class A buildings and Class B and C buildings. So I think that in industrial, the fact that the large warehouse buildings, the Amazon kinds of buildings, that they are really slow on leasing right now is because they were overbuilt. I think that developers don't collude, so they don't call each other and say, hey, Chad, we're thinking of building a 500,000 foot building. Are you going to build one to compete with us? There's not like a phone tree of those people. So each developer goes and gets their institutional money where they make a fee whether the deal works or it doesn't work. It's always better if it works because then they get a promote, a carried interest. But if it doesn't work, they still make an upfront fee and they still have something to advertise and stay busy. But those kinds of buildings are written about and are talked about differently in our little world, in the industrial world, than they are in the press. So that's what I see. I see that they're grouped together by unsophisticated people who don't understand the nuance.
Very well said. So, with that, then, can you explain the nuance? If you were trying to educate somebody in the media and they actually had a genuine interest in learning and not just writing another sensationalist clickbait headline, but they actually had a genuine interest in learning, how would you educate them on that?
Okay, so in the Chicago market, we have 15,000 buildings. Of those 15,000, and this is just a microcosm of the U.S. market, the Chicago generally represents 5% of the U.S. market in all things. So if you were to multiply the square footage or the number of buildings, if there's 15,000 buildings here and you multiply that times 20, that means that there are roughly, what would that make it, 300,000 real industrial buildings in the United States. And Canada's got its percentage also. You probably know what it is. I don't. But whatever the U.S. is, Canada's got a fraction of that amount. I'm guessing Canada might be close in total to the Chicago market. Yes, maybe.
You'd be surprised, actually. Toronto itself is about 1 billion square feet. So Toronto's a big market. And then there's the other major markets too, Montreal, Vancouver, Calgary, Edmonton. So
Okay.
I would say as a rough ballpark, just like if Chicago is 5% of the market, Canada seems to be 10% of everything that the US does.
Okay.
Population, all of that. So I would say as a rough number, 10% would be a good guide.
So that's a good number. Okay. So there might be 30,000 industrial buildings in Canada where there are 15,000 in the Chicago market. If that's the case, and I'm not sure of that statistic, but in our market, there are only 1,000 companies out of 20,000 companies that could possibly use a building that's greater than 150,000 square feet, which means that there are many more tenants than there are buildings. Let's say that there's 22,000 occupants, that occupy the 15,000 buildings. So there's 21,000 companies that are under 150,000 square feet, and there's 1,000 companies that are over 150,000 square feet. It's probably a pretty close statistic to what the reality is. So when that 1,000 companies, when their demand has been exhausted because they've all done a flurry of activity over the past 4 years, you run out. Maybe of those 1,000, perhaps half of them aren't doing anything. So there's 500 in play. And I'm going to guess that 450 of those 500 in the last 5 years have done something, which leaves a very small number of large building users that are floating around. And not all 50 of them, because that's all there are going to be 50. Not all 50 of them are actually going to do a deal. So it's possible that where we did 400 something deals over the past 4 years, which was 100 deals a year in that size range, it is very possible that this year we're going to do 10% of that.
Wow.
Yeah. When I say 10% of that, I mean 10% of the annual, not 10% of what it was for the entire 4-year boom period. But that would be like 2.5%. So let's assume that there are 70 buildings of 150,000 square feet and larger that are either available or coming available in the Chicago market, either now or sometime in the next 12 months. If there are only 15 or 20 tenants for those buildings, you're talking about wicked competition by the developers and the people that they represent to find a tenant, because it's like musical chairs. That 3/4 of those buildings are not going to get leased if the market stays like it is now, which is slow. If there's some sort of a resurgence, if there's like a Trump resurgence of onshoring and reshoring and people scared to death that they're going to get taxed like crazy with these tariffs, it's possible that maybe there will be a giant big blow up in demand again. But I don't know. What if the economy doesn't do well? It could drag everything down. So my end of the real estate business, it's not even smaller than 150,000 square feet. My end is smaller than 30,000 square feet because I don't have the capacity as a syndicator with my 250 investors who put $50 or $100,000 into every deal. We don't have the staying power and capacity to weather vacancies in 50, 70, and 100,000 square foot buildings. But if there's a 20,000 square foot building and it's vacant for 6 months or a year, I can handle that. That's like me carrying my house. So it's not that big of a deal. And in mass, for the whole market in the under 30,000 square foot space, there's virtually nothing for sale. Every user that has money, so every privately owned company, the owner of that company feels they're pissing away their money if they're leasing, and they're all looking to buy. So the difference between the bombers, where maybe there's 15 or 20 users for 70 vacancies, in our world, there's nothing available and maybe 50 or 70 companies looking to buy buildings under 30,000 square feet, which has bid up the pricing on the buildings that are 10,000 to 30,000 square feet from where it was. I sold a building 4 years ago for $80 a square foot. That same building and everything like it is now selling for $120 a foot. It's gone up 50% in 4 years. It's gone up more than 10% on average per year for 4 years. And it's not going down. It's staying there.
So with you competing now, not just with fellow investors, but competing with the owner-occupier pool of companies that want to own the real estate, I'm assuming that's just why it's so challenging to find deals right now. Limited inventory, hard to make sense of an investment thesis if you're going up against an owner-user who can typically justify more than being on an investment basis.
Yeah.
Sorry, go ahead.
I have a great story for you. We own 2 buildings in a town here called Elmhurst, which is a very high-end bedroom community where entrepreneurs love living and love having their manufacturing or distribution business within 10 minutes of their house. So there are 60 industrial buildings in the Elmhurst Industrial Park, and we own 3 of them. One is 17,000 square feet, one is 20,000 feet, and one is 22,000 feet. So we have the 22,000 feet on a street aptly called Industrial Drive. And our tenant left about 2 years ago. And the next door neighbor saw that we put a sign up, and he called and he said, "I want to buy your building." And I said, "It's not for sale. We're long-term holders. We're not selling." So he said, "Come meet with me." So at the time, buildings were selling for around $100 a square foot. And he said to me, "I am willing to pay you 20% premium. I'll pay you $120 for a building that I know all the brokers in town have told me is worth at the most $100 a square foot." I said, "No, we're not selling it." Well, it was right next door to him. And the way his business works is he needs to have everything under one roof. The next best thing is to have an overhead door in his building and an overhead door in our building and a parking lot in between. And very often, I've counted that there's at least 60 of these. Very often, there's a link between 2 buildings where they put up a metal frame and a canvas top and canvas sides so that in the bad weather and the rain and so forth, the forklift trucks and people can walk between the buildings or ride between the buildings. And this guy's next door. So he's the perfect candidate to lease our building and build one of those canvas hallways. So we said, "We're not going to sell it." And he said, then I have to lease it. So we leased it to him for $8 a foot, which was 30% higher than it would have leased for 2 years earlier because the market was going crazy like it has in Canada. I couldn't believe what he was paying. And he's in the building for about a year, and I get an email. He says, "Joel, I'm sick of this. I'm sick of paying rent. I'm sick of this." He says, "I know what I told you I'd pay. I will pay much more than that." This is an email. "I will way, 4 ways overpay if you'll sell me this building." That's the user sale mentality. He needs the building. There's nowhere else for him. I'm the only building next door.
Did you sell it to
Crazy.
him?
No,
Still held on to it.
we're renewing his lease.
It
No, we're just long-term holders. The age-old question is, are we sellers or are we holders? Are we an operating business or are we investors? And we look at ourselves as investors for the long term. And I'm probably making a mistake. I probably should sell it to him for $160, but we're going to keep it, and hopefully it'll be worth $200 in 10 years. And we'll collect rent, and we own the building next to it. So we're like playing Monopoly. We like to own 3 buildings in a row. Maybe eventually we get a hotel.
There actually is, I don't know if I have it here, there actually is an industrial real estate monopoly edition that Pro
Oh,
Law just put out in, I think it was 2007 or so. I have 2 copies of it now. It's awesome. So you're doing that in real life.
yeah, yeah.
So what would you say the differences are if just even high level, doesn't need to be precise, but vacancy rates right now for 300,000 square foot warehouse space, typical cookie cutter warehouse, vacancy rate for that, and then what's the vacancy rate? I know you mentioned that there's none available for sale, but on the lease basis, call it a 20, 30,000 square foot building in Chicago, what would the 2 vacancy rates be?
The vacancy rate on the big stuff is probably unbeknownst to the people who don't do statistics just on that. And they just look at the market as a whole. I think that we're about 7.5 in the market as a whole. And I believe because of the overbuilding, it's probably about 10% on the big bombers. And in our small stuff, it's probably about 5.5%. So that entire market, 7.5-ish, does not really reflect the trouble in the spec buildings. There's a group here that is called Dermody. They're not from here, but they bought a 200-acre parcel that used to be the Allstate Insurance headquarters. And they tore down those buildings that were connected by a hallway, by the way, but they were office buildings. And they built some spec buildings. I think that right now they have 5 spec buildings, and I believe they have room there to do about 2.5 or 3 million square feet in multiple buildings. There are 5 buildings. They leased part of one, and that tenant was from California in the food business and made a decision after signing the lease that they actually weren't going to move here. So the building is fully available, which means all 5 spec buildings are completely available. And that's just one example. Across the tollway from that building is another 420,000 square foot building, also sitting there with no tenants. This is bad, right? This is terrible. The industrial market in that sub-market is getting a bad reputation as being unleasable for the time being. Whereas 20 and 30,000 square foot buildings are leasing, but slowly. Not like it's booming. The leasing is not good. The sales are good because nothing's for sale. Because no seller like me. You saw my attitude about selling. They're all like me. Nobody wants to sell. They all want to keep it. They don't want to pay the tax on the sale when they make a gain. And then where are they going to put the money anyway? And there's a sort of a pride of ownership when you have a bunch of little buildings, or if you're a company and dad built this building in 1968, and now we have a tenant because our company got bought out by private equity. We're going to keep it. It's got sentimental value. Dad built it, 1968. To get up to pry that building out of the hands of that son of the founder, you'd have better luck. I don't know what it would take, but you'd have better luck trying to convince somebody to take gold nuggets. Those people will not sell. And that's why it's so difficult to find anything to buy.
Yeah, I think that's such a powerful thing to note, is that there really is a big difference between the different parts of industrial subcategories. Because like you said, there's a lot of that big box stuff vacant, not just in Chicago, but Phoenix and Dallas, both built several tens of millions of square feet worth of warehouse space on spec, thinking that the demand would continue growing at this exponential pace, when in reality, it's a cycle like everything else. And I think we are going to go into that cycle right now of too much warehouse space has to get eaten up. There hasn't been a whole lot developed though either. So at some point, with interest rates being higher, there could be a lag in future developments. So at some point when the economy starts picking up again, we could see it. But I think I like how you described it. If in Chicago, and I think this is characteristic of a lot of markets, if the average vacancy rate is 7.5%, but warehouses, the true number, if you were to actually just focus on that, would be 10%, and the smaller class B or whatever you want to call it space is 5%, that's a massive distortion in how those numbers are. Someone might think they might put too much emphasis on saying, well, the vacancy rate's 7.5%, and they might put too much value on the warehouse space, not factoring in all that risk, and conversely do the opposite on the smaller stuff. When you're explaining this, because you've got 250 investors and you're active in the community, you 40 plus years in the business, how do you explain that? Or is that just something that it's almost a pride of insider information that you have access to this data that isn't publicly available?
Yeah, it is not publicly available, and I don't express it to anybody when I'm talking to them because it's too down in the weeds. Yeah. Nobody really wants to hear the drill down into the basic depths of the super inside knowledge of our business. Everybody sort of likes to look at the big picture and break it down, and I call it boiling it down. My wife, when I boil things down, she says, "You're exaggerating." And I said, "No, I'm not exaggerating. I'm boiling it down." And I say this nicely to her, if you can't see all of the little bits and pieces of something when someone explains it to you because you really only remember 10% of what anyone says to you in life, I think our brains don't work very well in really understanding the messages that people are giving us, and they're misunderstood. Talking about the various elements of industrial real estate is going to be the most boring thing to anybody but to you and to me and the people who have SIOR designations, right? So it's just the big picture. Nobody wants to hear the details of it. And when I talk to an investor for a new deal, I do a little bit of the explanation of the difference between entrepreneurial small buildings and the big bombers that are owned primarily by pension funds. And they don't really care what I'm saying. If I went the other way and I said, "Oh, these bombers are great, and right now there's a lull, but they're going to fill up and they're going to be great," they'd say, "Okay, Joel, if that's what you say, that's right. Good, good." So when I explain it, they don't really want to hear it. So all I can do is tell them what my focus is and what the returns are, what the yield is on a $50,000 investment in a 20,000 square foot building. That's all they want to hear. They don't want all this background and all the other stuff about every building in every submarket of our area. And then when I flood the zone with too much information, they get overloaded and then they don't invest.
Well, understandably so. I mean, that's almost a cardinal rule in investing is only invest in things you understand. And if you start getting really deep into anything, there's probably not a whole lot that you'd gather. If you're an outsider and not in the industry, I can see how people would just get overwhelmed very quickly. Are you sensing, because I know you've got a very successful program going with Brit Properties. Are you aware, are you following any other syndicators that perhaps have went more on the side of chasing these big bombers, or maybe they're even in different asset classes, like apartment buildings or maybe office space? Are you aware of anyone right now that's struggling, trying to figure out where to go?
Yeah. I am a student of the syndication business, and I can give you a lot of statistics on the syndication business. In North America, there are 4,000 syndicators, plus or minus, with $100 million portfolio or greater.
Wow.
Okay, so some of them have $1 billion, some have $2.5 billion, some have $150 million. And of those 4,000 syndicators, I would say that 90% of them are having a bad year, and struggling is an understatement. And if you watch some of them on the other podcasts that do talk about multifamily, they're all just crying in the beer of each other's conversations. I was listening to, Bigger Pockets,
Mm-hmm.
The fellow who used to be with them, Green.
Is that the beard?
Yeah,
The guy. Yeah.
yeah. And then Ryan Pineda, who's out of Vegas.
Yep.
I watched a podcast yesterday. It wasn't really a podcast. It was a conversation between the two of them. And all they were doing was talking about how their lives have changed and how their faith and belief in God is really important to them now because that's more important than money.
Hmm.
Interesting conversation. That's what happens. People get real spiritual when they're losing. When they're winning, they get cocky. When they're losing, they look at life in a different way and they realize they didn't have any humility and they were making all these big mistakes. I would say that I haven't heard a positive thing out of a multifamily syndicator out of the last 100 conversations I've had with them. Not one positive thing. The ones who had floating rate debt got just killed, crushed. The ones who made projections that they were going to sell for a lower cap rate and they were going to raise rents, crushed. Rents are going down in that area. They're not going up. The mistakes that they made underwriting where they said, oh yeah, we're buying this class B, which is really a C, so it was a lie anyway. We're buying this class B and it's going to be great. They forgot to anticipate the new parking lot, the HVAC problems, the roof problems, and the vacancies that they're facing and the lower rents. The only ones who are doing well are the ones who are doing class A, who really know what they're doing. There's no maintenance mistakes. And the renters in these multifamily units are wealthy people that just don't want to have a house. It's not that they're workforce labor people. These are folks who they lived in a $2 million house and they downsized to a $4,000 a month apartment building. So it's rough out there. I don't see that in industrial because industrial people have a different market. It's a market of single tenant buildings where the tenants can't move out and they can't argue with the landlord who's trying to raise the rent because they can't move their machines because it would cost them $1 million to move. So they have no leverage. So industrial is better because the sticky tenants can't leave across the board.
Yeah, you're right. I've noticed the same thing as well. I don't follow the other syndication asset classes, but I follow industrial quite closely, and I don't know a single person that's actually, there could be somebody out there that just over leveraged and perhaps bought one big giant warehouse and then had a tenant come up. That I'm sure that there are outliers, and I'm sure that there are some people that have just been unfortunate. But for the most part, I don't know a single industrial syndicator or owner for that matter that's actually struggling because triple net leases. So even if there's been, and because that's also crushed multifamily, is you've had insurance costs skyrocket, property taxes are a problem in every city. That just erodes the gross revenue coming in. Whereas of industrial, it's all on a triple net basis. The increases generally just pass through to the tenant either. So they don't have that same exposure risk to the multifamily side.
There's no distress yet in industrial. But I will tell you, in 40 years of doing this, what I've learned is that industrial does eventually fall into the same distressed category as everything else eventually, because real estate is real estate. You know, we talked about how you can't differentiate between the big boxes and the small. Mm-hmm. Real estate is real estate. So again, the press, you look at these online articles and you watch the interviews on the business shows on TV. It's going to happen. It's starting. There has to be a downturn in industrial that follows the downturn in everything else. The question is what's going to happen with residential in general, with the home market. And I've been watching this great podcast called Thoughtful Money with a fellow by the name of Adam Taggart. And he had a guest on, a woman that was talking about residential and how she sees likely a somewhat of a crash that's going to take place early next year. You know, they're all guessing. Nobody knows. But industrial does follow and always has. It's just somewhere between 6 months and a year behind everything else.
Yeah, there's a guy at the University of Denver. I can't remember his first name, but Mueller is his last name, and he puts out a report called the Mueller. I'd butcher it if I even put it out, but puts it out quarterly, and he studies all asset classes, and he's really big on cycles as well. Like he believes unwaveringly that everything follows a traditional cycle, and that doesn't mean that it's 2 years for each quadrant of the cycle, but it follows that trajectory. And he was saying the same thing, and I believe this too. Cycles will cycle, and industrial is no different. I'm 20 years in the business, so I haven't seen the ebbs and flows that you've seen over a longer career, but it will cycle. I'm with you. I have no idea when. It's always fascinating hearing these people project that the housing market's going to crash tomorrow, or someone might say might go up 10% next year, and I don't think anybody has a clue. But I'm with you. It will cycle. What do you think triggers that? Is it just the housing market goes first and then industrial follows 6 to 12 months later, or is there a catalyst event?
There's always a catalyst event. There's always one. In today's world, the catalyst event is unclear. We don't know what it is, but there are a bunch of things lurking. And I would say that the biggest problem is that the central banks, the Federal Reserve and the central banks that follow in the footsteps of the Federal Reserve and copy what the Federal Reserve does, has created so much liquidity by buying bonds, by taking onto their balance sheet all this debt. And there's so much debt in the U.S. that there's $36 trillion worth of public debt, and there's another $65 trillion of private debt. So there's $100 trillion of debt. And the reason that it hasn't blown up yet, based on these economists that I watch when I work out on my treadmill, they say that it hasn't blown up yet because the Federal Reserve, for example, can create liquidity. They can print money. But what's happening now that might be the thing that turns it is that the Federal Reserve has controlled interest rates by controlling the federal rate. So when they had what they called ZIRP, which was the federal rate being almost at zero, interest rates were very low. And then cap rates were very low. And then when they started to raise rates to tamp down inflation, what happened? Interest rates went up. You could borrow at the bank, but you couldn't borrow for 3% or 4%. Now you're at 6, 7, or even 8. So this disaster happened, and that's why all these developers and syndicators are in so much trouble, because there's this wall out there of refinancing that has to take place, and right now the rates are too high. But this is the big problem that the economists are talking about. The Federal Reserve is going to find itself, according to many, in a position where they're trying to control rates but can't. And rates will go up in spite of them keeping the federal rate low or even reducing it to stimulate the economy. The reason that these rates may go up is because who wants our debt? Our debt is dangerous. It's dangerous. Everyone says the U.S. will never default on debt. Well, that may be true, but it starts to get junky, that debt, when it becomes so high that people are worried about it. And so even though the Federal Reserve is going to try to keep the rates low, the market may send the rates higher, which means Treasury bills, which I own a bunch of because they're almost paying 5%. And what else do you do safe with your money? The Federal Reserve has been controlling that with their federal rate. But if people don't want to buy the bonds and the bills, supply and demand, which Sam Zell said, everything comes down to supply and demand eventually, even if it's fake for a while. Eventually, the rates can go up out of control and the Fed won't be able to control it. And that could cause a major downturn because our rates could go back up to 10%. When I was doing deals my first deals in the 1980s, I was borrowing at 10%. And I didn't think that was bad. Cap rates were 10%. It's funny how the cap rate's very similar to the interest rate that you can borrow at the bank for your real estate. So I don't know. Maybe it's going back up to 10%. That would not be good for real estate. That would not be good for developers, syndicators, homeowners, or anybody else. So these economists don't agree on what's going to happen. Some of them say the opposite of this, but there's a whole group of them that are highly sophisticated who are saying exactly this. Stan Druckenmiller is one of them. There's a woman, Stephanie Pomboy. These people are worried that the economy is almost out of control, and when that happens, that could be the event. When it's determined that, there's too much debt. Rates are going up beyond what the Fed can control. That could cause a big disaster.
Yeah, and that decoupling between the overnight rate and the bond market, they'd like to have perfect control over that, but like you said, it's supply and demand, so that could come fairly easy.
Well, it already has. Long rates have gone up 75 basis points beyond what the Fed wanted it to while they were trying to control it. So the 10-year is higher than it's supposed to be. It's sort of happening.
Well, and then I suppose you could also add on the fact that Trump is now saying that he'd like to put some pretty heavy tariffs on imports, which especially punishing China, which a lot of stuff is coming from China. What that will lead is to retaliatory tariffs being put on by other countries. And then all of a sudden, we're going to see an even more inflationary environment because it just gets passed on to the consumer.
This is Sheinbaum, who's the president of Mexico, yesterday came out and said, "You want to fight? We'll give you a fight. We'll do the same to you." Not good.
I mean, no country is just going to take that laying down because they're all serving their citizens as well. So they're not going to take that line down. It's all going to get passed on to the consumer, which is going to lead to even more problematic inflation. You can't put and maybe it's bravado at this point. Maybe it comes off significantly from there. I mean, Trump is a negotiator, so maybe he throws out 25%, and then when it comes down to 10%, everyone thinks it's a great deal. I don't know what the end result is, but that will be inflationary. So now you're going to have the Feds trying to control inflation. How do you lower interest rates when you have higher inflation and then the bond market's not responding anyways?
Yeah, it's exactly right. So what Adam Taggart would now ask at this point in his podcast, he would say, so most of the people who watch this, most of his 80,000 people who watch this, are hearing these big picture things about the economy. He says, but most of them are just trying to make good investments and make sure their families are safe and that when they get older that they don't have to move into a public housing facility. They want to make sure that their investments are strong and safe and that they're putting their money in the right place and doing the right things. So the question is, what do we do about it? All these things may or may not happen. All I can only do one thing. All I can do is have a philosophy and a strategy for the most protective way of doing what we do as possible. So you know this about me. I went through 2008. I went into an incredible hopeless funk. I didn't like it. I had this lady at the bank who told me she was going to take me down because I had 7 loans at this one bank and I was only in default on one. But she says the one loan is in workout, and if one's in workout, they're all in workout. I never want to have that happen again. So in my case, the answer for me, which does not work for hardly anybody else, is to do very little debt, like 30% loan to value, or zero debt. And I'm leaning to zero debt so that if this whole thing blows up, we're okay. We don't have to pay the bank and the bank's not going to take the keys away. And that's the only thing that I know how to do. And that's when I have the conversations with investors now, what I say to them is, if you invest with me, you're going to get the most unusual syndication you've ever seen because I don't believe in debt. And they say, what? It's real estate. You should borrow as much as you can. And we've been putting these deals together. I'm paying $130 a foot for a building right now. If I had a mortgage of 70% loan to value on that deal, which theoretically most people like, or even a 60%, I'm talking about a mortgage that's somewhere close to $800,000. And if something goes wrong and there's no tenant, I still have to pay the loan. If the rates go up, I have to pay the higher rate. I have to pay the taxes, the insurance, the maintenance, and the utilities. And if it needs a new roof, there's nowhere to go. And that's what's happening to all these people with office buildings. They're getting crushed because their mortgages are too high and the buildings aren't worth enough to even pay off the mortgages. So all these lenders are foreclosing. We've got a business journal here called Crane's Chicago Business. Every single day, there's another building going back to a lender where the owner is upside down. And it's all about the debt. Debt's dangerous. And so that's my answer to this for whatever it's worth. And I can only do it in a small building context. I couldn't go buy a $30 million giant warehouse with syndicated equity. Because if I have 250 investors and the most that anybody will put into a deal is 100,000 and my average is 50,000, I can't buy the big property all cash. I've got to get at least a 50% mortgage. And with that, I can't sleep at night knowing that we might be around the corner from a downturn.
There's something you said there that really struck me, is that the one owner per day just in Chicago being taken into special accounts because they're upside down. You can't be upside down on a property if you don't have debt on it. Even if someone bought an office property 20 years ago and maybe they paid $100 million for it and it's $20 million now, if they bought it for cash, they're not upside down on it. They've lost a lot of equity, but they're not upside down on it. There's still $20 million there, versus if they had a $60 million note on there and maybe they've paid off a little bit of it, but now they're upside down. Now they're in a position where you can't keep that property. So I think that there's something really profound, and I've come a long way in my own investing journey, is that debt, for as many good things as it does have in good times, positive leverage and a case of arbitrage where you can borrow at X and theoretically make Y, that makes a lot of sense in a low interest rate environment. But the last 2 years has taught us anything, is that there's a lot of risk that doesn't get priced into that either.
Yeah, debt can make you rich and it can make you poor.
Yeah, that's a great saying on it. So when you go in and buy, typically with cash or perhaps up to 30% in some scenarios, are you structuring that? How do you make your pro forma? Because I mean, this is one thing that really peeves of mine about real estate, is that you can take a 10-year projection and a pro forma and you can manipulate certain numbers here or there. Maybe it's just your exit cap rate, or maybe it's your growth projections, or you understate your expenses, whatever you want. There's a million different ways to manipulate a pro forma. And debt's another one of those levers that you can pull. If you're going in and saying that you're just buying this as cash, does that not perhaps make your returns look less than a over aggressive syndicator who's going to say, well, we're going to use positive leverage, we're going to make all these assumptions, and we're going to show a higher return? Or is it just a trade-off that your investors are willing to accept less of a theoretical projected return in exchange for lower risk?
Great question. The bottom line is the same in every one of my deals. If I can't get a 7% yield, not a 7 cap, a 7% yield, which means you need a 7.5 or 8% cap rate, because we do have expenses. People forget that there are expenses. When you buy a cap rate, that's not the return. That's the cap rate. So you have to figure out all your expenses. And in the case of having debt, you have to figure out your debt service and so forth. In today's world, with today's debt service, if you are amortizing, there's no difference in the yield between if I buy a building all cash or if I buy it and I put a 50 or 70% loan on it at today's interest rates, which are 6.5%. Because 6.5% interest, if it's not an interest-only loan, and most lenders don't like interest-only for longer than about a year or two. Eventually, if you're a long-term holder, the amortization brings a 6.5% loan to what's called an 8% constant. So if I'm getting a 7.5 cap and I have debt, I've got negative leverage when you think about it. So my investors they'll be lucky to make a 5.5 or 6% yield. Buying it all cash, if I buy it for an 8 cap, I know that my expenses are about a half a point. If it's a triple net lease, let's say. Because I still have to pay the accountants to do the tax return. I still have to pay for a roof inspection, even though the tenant may be paying for some of the roof repairs. They're not inspecting it without me telling them to, and I don't want to be I want to know my roof conditions, right? And I also have, most leases have some sharing of major capital expenses with a tenant. And I've also got property management. And although sometimes you can pass that through, sometimes you can't, and the owner has to pay it. In many of our deals, I don't want to argue with the tenant. When they say it's a single tenant building, I'm a net lease tenant, why am I paying you a management fee? I'm managing it myself as the occupant. I say, yeah, you're right. Okay. So now I have to underwrite a reduction in my return for the 3 or 4% property management fee. So I'm not going to buy a building unless I get an 8% cap rate. Reason being, that's a 7 to a 7.5% yield on an all cash basis. But that same deal with debt at today's rates, with a ton of risk of things going bad that you don't expect, it's a yield of 6%. So the yield is lower when there's debt today. When it was different when rates were low. But who knows when they're going to go back, if they ever do. So I sleep better at night knowing that I'm actually getting a 7% return from my investors, and I don't have to worry about what rates do. And I don't have to worry about if I need a new roof, because if I'm responsible as a landlord for a new roof and I've got no debt, I can now go borrow the money for the roof. A roof might be $15 a foot US on a building that's a $130 building. You know, in that case, I'm at a 10% loan to value, and I now have a new roof, and I still have a small loan. So I'm just a messed up thinker, I guess. You know, I'm not a risk taker. I've seen people land in very bad places. I've seen literally suicides in real estate where people took too much risk and they blew their family's everything, and they had to start over, and they weren't ready to start over. They were too embarrassed. They were too big shots. You know, I'm a big shot. They can't afford their car. They can't afford their plane. There was a book called A Man in Full that was about this very subject.
Yep,
and it's a great book, and it says what can happen if you have too much debt and the bank owns you. You know, you're a slave to the bank. So in my case, I'm just a weird guy who just does these all cash deals in my little niche, you know, and I look at the big picture and I just scratch my head like, how much risk are these people taking? And I also think, as I scratch my head, how stupid am I? Because if the market gets great and things go crazy and they have a lot of debt, they're going to make millions and millions and millions. And I might make only hundreds of thousands. But it starts out with a better yield.
And I think that there's something to be said about the relationship between risk and reward. And yes, if you're willing to take big risks and it goes the right way for you, you're right. You can have some really big rewards, but that can also magnify the other way. And it's just with leverage, going back to what we were talking about. If you buy a property with 70% debt on it, the market drops 30%, you just lost 100% of your investment. And I think that's what a lot of people underestimate, especially those investors that don't ask a lot of questions, and they're just like, okay, well, what does this look like? I hope you can perform on it. I hope everything comes to fruition that you're suggesting. But what happens? A multifamily investor right now, someone that bought into a syndication 2-3 years ago, and it's probably underwater right now. If that syndicator put debt on it, it's probably underwater.
Yeah, I have a syndication theory. My syndicated investors are addicted to investing in syndications. I went to the Best Ever conference in Salt Lake City in March. My son Sam and I went, and I met hundreds of investors. They're addicts. They can't wait till the next deal comes out. And they were starting to see cash calls and losses in March. It wasn't real bad, but it was pretty bad. Lately, when I talk to investors who are new to me, and I say, how many deals are you in? And they say, well, I'm in 27 syndications. Wow. I say, and how many are cash flowing, and how many have paused, and how many are cash calls? let's say out of that number of 27, 23 are in trouble in some way. Paused cash flow, not enough money to cover this and cover that. And the syndicators are really scared to death. And they're trying to figure out, again, they get spiritual all of a sudden, because when money isn't your only thing, you look maybe to God or maybe to what's more important in life. And that's what I'm seeing. I'm seeing a lot of that. And people say to me, well, if I go into your deal and it's all cash, will there be a cash call? And I say, I can't predict the one thing that is the worst thing that can happen to us, and that's vacancy. I can predict a lot of things. I can predict a roof. I can predict a parking lot. I can predict a heating unit. But if our building goes vacant and the market sucks and we don't get a tenant and it sits vacant for a year or two, single tenant building, good luck. That is, if you have 70% debt and you have a year of vacancy, you have to fill it up. You have to pay the commission to the broker, right? In your market, isn't it a commission and a half? The tenant rep gets a full commission and the broker for the owner gets a half. So you're paying a commission and a half and all the vacancy and a little bit of free rent. And maybe they need carpet and paint, not much, but something. All of a sudden, you can be in real trouble, even in industrial, with that. It hasn't happened yet to too many, but that's what I'm worried about.
Yeah, I'm glad you said that, because I know that I'm often very optimistic, and my long-term outlook on industrial still hasn't changed. I'm still very bullish, but that doesn't negate the fact that there are risks and there are things that could happen that could derail our market and put industrial into peril just the same as offices right now. It's there that what's the name for it, when an uncertain event. So I've drawn a blank on it, but there
Black swan.
Black swan, yeah, the Nick Taleb who came up with that term. There could be a black swan that happens in industrial, and that's the whole thing with a black swan, is that you don't see it coming. It literally just comes out of nowhere, and it's unpredictable. I think the one thing that I'd really stressed, and I say this to investors that are considering syndications, is that nobody, or very few people anyways, actually take into account the downside risk of investing in a syndication. And I would say only invest money in a syndication that you are perfectly fine losing altogether. Because going back to that analogy, and I'm probably sounding very redundant on this, but you buy a property and there's debt on there and the market drops by the same amount of equity in there, 100% of that investment is now gone. And it doesn't take much to see a 20, 30% swing in the market. Offices saw a multiple of that already. I like your strategy. I don't think that that's weird at all, because if somebody does invest in there isn't that risk of it going to zero. There's a very real risk. And being a limited partner, that's what it is. Your investment is limited to the amount that you have in there, but that also means that it can be 100% gone with nothing else happening. You just lose 100% of your investment as an LP.
Yeah, I have one thing that I believe in what you're saying is true. One of the things that I recently did is I did a study of what rents have been since the 1960s in industrial buildings. I did a chart. And if you look at the chart, the trend is our friend. The trend's up. In 1963, industrial rents were in the $1.50 a foot range. In the 1950s, they were signing 20-year deals at 60 cents. And by the way, they didn't know what inflation was, so they'd sign a 20-year deal at 60 cents and give the tenant an option to renew 20 years later at 30 cents because they figured they'd already paid off their mortgage. Those were people who just didn't understand what was going to happen in the future, right? I saw those deals when I first got in the business in the 1980s because they were coming due as the renewal option at 30 cents. But the trend is our friend. And in the 1970s, rents were about $3. And in the 80s, they were in the 4s. And in the 90s, they were in the 5s. In the 2000s, they were in the 5s plus, almost 6. And then 2008, they dropped down by $1. And then they went back up. And then during COVID, they went down for 4 months. And then they went way up. But the trend is our friend. So in the long term, if you have the staying power, That's all that matters. Because if things go bad and you have staying power, the trend is our friend. 20 years from today, what today might be not $8 or $9 rents are probably going to be $16 rents. You just have to live through the downside that can happen to get to 20 years out where the rents are $16. And if that happens, it's a win. So that's our whole thing, is the staying power to make it through those little downs and sometimes big downs that happen. But the most it's ever gone down in our market in 2008, rents only went down 25%. And values only went down 25%. So if I look at it this way, an all cash deal at $100, if I had a $100 building back then and it went down 25%, it's still worth 75. I've only lost 25% of my money on paper. And then because the trend is our friend, that same building, which was down to $75, is now up to 120 because we made it through.
Yeah, I had this conversation with someone the other day, actually. It was a person new into the business, and they were trying to do a bunch of things out they thought would make them quick money. And my message to them was, it is very, very difficult, if not impossible, to get rich quick, at least in real estate. You can get lucky. There's somebody out there that might get lucky, but that's akin to playing the lottery and relying on luck. To actually get rich quick systematically is very, very difficult. But getting rich over time, it's almost difficult to not get rich over time, because you start riding all those trends that you start seeing. And if your investment thesis is that Canada and US and Mexico and other major economies, if you believe that those economies are going to keep growing over time, then that's a pretty strong thesis to bet on. And I like real estate for a number of reasons. It's very hard to fail if you're responsible with investing over time. That staying power that you mentioned. And yeah, I'd go back to that comment. I don't think that that's weird at all. I think that's actually a very prudent investment strategy, because you're almost guaranteeing to some extent. Well, that's a tough word to use in real estate, but you're banking on the fact that you have a lot more staying power than somebody that's going to be victim to mortgage and everything that comes with that.
Yeah. That's our thesis, and it comes with age. You know, I'm significantly older than you are, and I've been in the business for 20 something more years. And I think risk is for young people because they can start over. I'm not saying anyone should do what I'm doing. I'm not recommending it. But for someone who's 65 years old, whose investors are an average of 65 years old, I've got some doctors in their 40s and airline pilots in their 40s who are investors with us, and people who sold their business and they were the son of the founder or the grandson, and they're in their 40s or 50s. I don't have any problem with someone who's younger taking more risk. I think it's crazy to be as risk averse as I am when you're trying to build your fortune, because it's hard to do, as you said. But at some point, you don't want to be in a position where if you happen to live to 95 years old, that you run out of money when you're 85 years old and your kids have to take care of you.
Yeah, that's a blueprint for a very unhappy later part of your life in that scenario. So I'm with you. I've taken on a lot of risk. I have a lot of debt that I've personally guaranteed on different properties, but I also haven't bought anything in the last 2 years because I've been trying to stockpile more money and be in more of a position. We had one property get renewed at a much higher rate than we bought in 2019 and got renewed this year on a 5-year fixed mortgage, and interest rates went up quite a bit, and all of a sudden the cash flow got eroded. So I've been very hesitant to buy anything, but I definitely see myself moving much more to your line of thinking of the less debt, the better, because you may leave a little bit on the table in terms of potential upside or returns or how big you could scale. But that peace of mind is something very important to me as well. I want to actually just get your closing comments. We're just at the top of the hour. It never ceases to amaze me how quick an hour goes by when we're talking about things that we love. I'd encourage investors to reach out to you. I know some did after the last call that we had, and I think people can just get a sense for your authenticity and your thesis and your outlook and how you manage things. So if investors are interested, I encourage them to reach out to you and see if there's a mutual fit. But one other thing that I'd also want to throw out is I know a lot of times there could be brokers or sellers or somebody that just has property and they say, well, this might actually work for Joel. So what are you looking for right now? If somebody was thinking of getting in touch with you to present an opportunity, what are you looking for?
Buildings under 30,000 square feet. Single tenant. I like good geometry. You and I have talked about this. The geometry has to be outstanding. I don't want to buy a building. Someone brought me a building where the back of the building was the front door. We have to drive around to get to the front door. So it's not obvious where the front is. Good geometry is nice looking, offices in the front, not too much office, loading docks with lots of good maneuvering room, a plentiful parking lot, and ceilings that are appropriate for the size. I'll do a 14-foot clear building if it's 10,000 square feet, but every 5,000 feet that you go up over 10,000 needs to be a foot higher.
That's a great rule of thumb. What specifically Greater Chicago, or are you expanding to other markets, or is that the preference?
The preference is Chicago market. We bought buildings in Florida and New York and Ohio. So I'm open to other markets for that size and that type of geometry. But it's so easy for us to be able to manage a property by driving there in 25 minutes. It's really better. So we're laser focused here. If the right building came along in Cleveland, sure. Florida, absolutely. I'd like to write off a trip to Florida and have it be a business trip that turns into a half vacation. So yes, Tampa. yes, Sarasota, Naples.
Yeah, well, especially with winter now upon us, it all of a sudden the Florida market looks pretty appealing for industrial investors.
It does.
Okay, well, I'll put your contact information in the show notes so people can reach out to you. Last word, anything you want to wrap up with on your thoughts as an investor, thoughts on the economy, outlook? Last word is all yours.
Oh, thank you. I want to just say that I think you're doing a great service to the industrial real estate community. I think one of the things that is most important is that you are thoughtful and you have good judgment. And at your age, more so than mine, it's hard for some people to have good judgment and be thoughtful because they're risk takers and they do a little more gambling than investing. And one of the reasons that I admire you so much is because you are thoughtful, you do interview people, you do learn, and you've got a strategy and a philosophy that makes sense as opposed to being impulsive, which many people are. And I say that your role model of that thoughtfulness is really important. And I give you lots of credit. And I wish that I had been more like you 20 years ago.
Well, thank you for the kind words, and I'd reciprocate it back. I hope I'm like you when I'm your age. So thank you for the kind words, and thank you for taking the time to share your insights. As always, I've had numerous people compliment you on the last interview we did. I'm sure this one's going to be the exact same, and we'll have to do another one in 2025 and get the hat trick.
That sounds great, Chad. Thank you.
Okay, well, thanks again, Joel. I really do appreciate it and look forward to keeping in touch. Hello, I'm Chad, and I'm excited to announce that we're now accepting new members for the 2025 Industrial Insiders membership group. And we're also having a Black Friday sale starting today and going until December 2nd. It will be $100 off, so it'll be $250 for the entire year. And with membership, you get access to our forum where members can ask and answer questions or talk about anything to do with industrial real estate. They also have the ability to join in on the podcast interviews we do and ask questions or interact with any of the guests. And also, I put out a weekly newsletter where I take all the interesting things that I find about industrial real estate over the week and send that out. It's exclusive just to members. I spend a lot of time on that and have a lot of fun with it. And I think it really does provide some good value. So if you're interested in signing up and networking with a bunch of other industrial real estate professionals, owners, developers, associated professionals, and just getting cutting edge information from podcast guests and newsletters, again, $100 off, $250 for the year. You can sign up at industrialize.com, and we'll also put a membership link if you want to sign up. Would love to have you on board for 2025 and looking forward to a fun year.